Hello, and thanks for joining us today for the Signature FD Weekly Investment Audiocast. I'm Tony Welch, Chief Investment Officer here at Signature FD. So, as usual, we're going to spend a bit of time here talking about last week's market action and that macroeconomic data that drove it. And we're also going to try to zoom out just a little bit to the bigger picture and briefly discuss what we're watching on a longer term perspective. And then we'll let you know what we're watching here in the week ahead. So, starting here with last week, I can most appropriately say, welcome to the difficult investing month that is September. Since 1980, September it's been down more times than it's been up for US large cap stocks. And the median performance for the month of September has been negative 0.2%. That makes it the only month that the median return is a loss. Now, we want to use median numbers so that we know it's not just one or two large down Septembers that are skewing the data. It really has historically been a difficult month for investors. And right on cue, last week saw a meaningful correction of about 4% for US large cap stocks. Now, bond yields fell on the week, so bond prices were higher. And I would also note that the other more risk seeking asset classes like commodities, those were down last week. In fact, a broad commodity index that we track from Bloomberg was down about 5% on the week. So it was very much a risk off move that we saw throughout the week last week. Still, year to date, large cap stocks are up almost 15%. So September has started very much in line. Now, the good news is that the period from October through December, that's tended to be the best stretch on the calendar for stocks, and that you've gained a median of almost 7% in that quarter time frame. Now, the most popular month on the calendar for a correction to end has actually been October. So it's possible that a September reset of market sentiment could resolve higher in the fourth quarter. Now, as for what we'd watch longer term to frame our expectations for whether a correction will turn into a bear market, I'd say lots of things, but there's really three main buckets. We follow longer term market trends, especially how many stocks are participating in advance, and we also watch market sentiment. And finally, we track the monetary and inflation backdrop. So for now, the trend evidence remains positive. Market sentiment slowly becoming more of a tailwind, and interest falling, and so is inflation, which is encouraging for the macro backdrop. So we remain optimistic for now that this is a correction, and it's one of the three corrections per year in an average year of 5% that the market does tend to experience. And it's not yet time to declare the beginning of a bear market. Now, as for what drove that weakness last week, it was primarily the batch of labor market data that we got. So the so-called JOLT survey, or the job openings and labor turnover survey, that showed that job openings continued to fall in July. Now we're essentially back to a pre-COVID level of job openings. The ADP payroll report showed job creation, but less than what economists had expected. And the same with the official Bureau of Labor Statistics Employment Situation Report. Jobs were being created in August, but a bit less than expected. And the prior 2 months saw some downward revisions. Now, parsing through the report, not all was bad news. Wages grew at a pretty robust 8%. Temporary unemployment eased. The unemployment rate ticked down a bit, and the cyclical construction sector continued to add jobs. So if somebody asked me for one sentence to sum up the labor market, I'd say less hiring, but not firing. That condition may be able to persist for longer than previous cycles just because this post-COVID labor market is very unique. Now, regardless, the futures markets are now pricing in a 100% chance that the Fed will cut interest rates at their next meeting, with the higher probability of interest rate cuts as 25 basis points rather than a 50 basis point cut. Now, for this week, we're going to be watching the inflation data. We get consumer prices on Tuesday, and that'll be followed up by producer prices and then import prices. CPI is forecast to come down from 2.9% to 2.6%, which, if realized, that could give the Fed more confidence in initiating that easing cycle. Now, we're also going to get an update on consumer confidence on Friday. And I'm interested in this reading because there are a lot of cross currents for the consumer at play. We've seen consumer spending hold up pretty robustly this year. Inflation adjusted wages have seen positive year over year growth really since Q1 of 2023. But the consumer did lose a lot of purchasing power in 2022, and they don't feel that they've caught up yet. Additionally, a tightening labor market that could weigh on sentiment. So we'll be watching the results of that survey and the anecdotal comments to see how the consumer feels today and going forward. Now, in any event, join us next week to hear our take on that inflation data and the health of the consumer. And as always, thank you for taking some time with us and have a great week ahead.